So in part one, we spent a lot of time talking about taxable temporary differences. And we said that those are amounts that will be taxed in the future, meaning that if you've got a taxable temporary difference of 100,000 and in future you make a profit of 0, this will ensure that you have 100,000 that will be taxed in the future because it will be recovered in the future. So it's like as a minimum, you are going to pay tax equivalent to the deferred tax liability now as a minimum. And now we are saying that if that is then the case, what are deductible temporary differences? If taxable temporary differences result in amounts that are taxable in the future, then deductible should result in amounts that are deductible in determining taxable income in the future. Oh, so if we recall, as I said, one of the things to recall what we've done, we remember that if we have a taxable temporary difference, in the current year, it's deducted and its taxation is deferred into the future years. That's a deferred tax liability. So if a deductible temporary difference is the opposite of taxable temporary difference, it means that in the current year, it will be taxed so that in future, it will then be deducted. And whatever is going to be deducted in the future should represent a benefit today. It should represent a benefit today. And that benefit is captured in the form of what? It's captured in the form of deferred tax asset, because it is a benefit of lower taxes. So it therefore follows that we will recognize deferred tax assets when we have deductible temporary differences and any unutilized or unused tax losses that we are carrying forward. So those are the instances where we will have deferred tax assets. So we're going to talk about the unused tax losses. So what are we talking about here? So we are saying deferred tax assets should be recognized for all temporary deductible differences to the extent that there will be an amount in the future. So let's just allow that to sink in. So I'm saying that I'm giving you an amount that you will deduct in future, but we have to agree that the value of this is that there is an amount that is going to be taxed in the future. If there is an amount that is going to be taxed in the future and you have the ability to reduce that, then you have a benefit. But there is a problem, because sometimes I could then say, imagine if I come to you and say, I want to give you a tax loss. And you're like, oh, what is a tax loss? A tax loss is an amount that you will deduct from your future income. Do you agree with me that that thing that I've given you will only have value if you expect to have future taxable income? In other words, it will be a saving on the tax that you expect to pay. If you don't expect to pay tax, then there should be no benefit to you. If I give you a tax loss of 500 million and you don't expect to make 500 million income in your lifetime, then that thing is not as nice, because it means that you will not be able to recognize its worth. But if it is given to, say, a billionaire, then they will say, thank you very much, I will save so much taxes in the future. So that is the same principle that is applicable here, to say that we will only recognize a benefit to the extent that we expect them to be what? To be income in the future. If there is not going to be any income, we don't recognize the benefit. So the income will be future revenues and profit that you will generate. That's clear. But then the standard says, if you don't expect to have any future income and expenses, we know as a minimum that you have taxable temporary difference that will be recovered in the future. And when you recover them in the future, you will have amounts that are taxable. You will have amounts that are taxable. So as a result, what does it mean? As a result, it will then mean that you will limit the recognition of a deferred tax asset to the taxable temporary difference. So let's just look at an example. CA Limited, a company with a year end of 30 June, is finalizing its tax affairs for the year end 30 June 2021. It has two items that it needs to finalize. And these are provision for leave and the machinery. The provision for leave is 150,000. The provision represents CA Limited's obligation to pay employees for absence from work. In accordance with the Income Tax Act, SARS allows a deduction only when cash is paid to the employees for being absent from work. A machinery was acquired on 1 July 2019 for an amount of 900,000. The useful life of that machine is 8 years with a residual value of 0. SARS allows a deduction based on 12C at a rate of 40% and 20% in each of the successive years. Profit before tax for the year ended 30 June 2021, which includes the effects of the above transactions or above information, is 2 million. At 30 June 2020, the tax liability amounted to 69,300, and the applicable tax rate is 28%. We are required to provide the tax disclosure, meaning the tax expense, that's 1. 2, it will be the tax reconciliation, and 3, the tax liability note. All right, or tax asset note. So let us go for it. So let me do a screenshot. Then I have lecture example number 8, and that is deductible differences. All right, so I have this here. And then step 1 is to do the movement. So I have a provision, I've got carrying amount, tax base, and temporary difference. Then what do I have? I've got minus 150. So then we remember what a tax base is. A tax base of a liability. What is it? It is the carrying amount of 150 less what? Less amounts that will be deducted in the future. So future deductions. So future deductions. It's what? It's 150. So as a result, it means that the tax base is 0. And we have 150 temporary difference. Then when it comes to the machinery, we are told that the cost of the machinery is 900,000. It was acquired on 1 July 2019, meaning 2020 was year 1, 2021, it means 2 years are down. And since it's got an 8-year useful life, we are left with 6 out of the 8. And from a SARS perspective, we got 40% in year 1, 20% in year 2. So we are left with simply 40%. And that means the difference is 315. So since these are the only two assets, it then means what? The temporary difference is 315,150. So that is what we have. And the deferred tax liability, 28%. And last year, what did they tell us? Last year, they said that the deferred tax liability was 69,300, meaning that the temporary difference will then be 247,500. Okay, so the movement is 82,500 and here 23,100. What do we notice? We notice that there was a decrease in the liability. A decrease in the liability is what? It's an income. All right, so that is our step number 1. So let me do this. So determine the movement. All right, step number 2 is to determine our current tax. Determine the current tax or taxable income. So profit before tax, how much was it? It was 2 million rand. And we have movement in temporary difference. So the movement in temporary difference is such that the liability has gone down. So the liability going down, it means that those amounts that we said are taxable in the future are now being taxed. We are actually in the future. So what does that mean? It means that we have taxable income of 20,82,500. Okay, let me just check something. No, it is not 300. Let me just quickly update that to 300 because I wanted this to illustrate a particular principle. So 300,000. Actually, let's make it 500,000. Okay. So let's make it 500,000. So minus 500,000. Okay. So 500,000 here. So let me just here. I don't know why I brought it back to 150, but okay. So I've got 500,000 here. And now what I want to just explain is the following, that now we've got a what? Now we have a negative answer. Then the question is, should we recognize a deferred tax asset? So in part A, we are saying that we are expecting to generate sufficient taxable income in the future, meaning that this deductible temporary difference that we have now, we expect to what? To utilize it in the future when we generate this what? When we generate this future taxable income. So as a result, we can recognize the full what? The full deferred tax asset. So we now have an asset, which is a minus for us. And it means you are moving from a liability to an asset. So simply said, it means that the asset is so great that it wipes off the liability. And we are now left with what? we are now left with an asset of 51,800. So now the movement, it means that if you are moving from 247,500 and you are moving to what? You are moving to 185. It means that the entire movement was 432. So it will have wiped off the 247 first and then create a liability, an asset of 185, meaning that the current tax, it's what? The current tax at 28% is 681,100. All right. Then step number 3, it is to do the tax expense note. So the tax expense note, we have current tax of 61,800. Then we have deferred tax, but it's an income. Why is it an income? Because we moved from a liability to an asset. And this will then be how much? This will then be 560. So that will then be the tax expense for the year. So the tax expense for the year, it is 560. Then what are the users expecting though? So the tax reconciliation item. So the tax reconciliation item, accounting profit before tax, it's what? It's 2 million. Then tax at 28%, it is 560. So there is no need for a tax recon because the tax that we have is the tax that we are expecting. So the key takeaway here is that what? Is that current deferred tax liability, if they are recognized, if we expect sufficient taxable income, what do we expect? We then expect there not to be any tax reconciling item. Now the question that I have is, what if we are not expecting sufficient taxable income? So now let's look at scenario B. So I'm going to call this 8A and I'm going to call this 8B. Then what do we have? We are saying we determine the movement. However, what are we looking at here? We are saying that when we get here, we do not expect to have sufficient taxable income. All right. So the recognition of deductible temporary differences will be limited. Is what? Is limited. Oh, so it's limited to what? It is limited to the existing taxable temporary difference. Okay, so that's interesting. So what does it mean? It means that in this case, we will then say that we've got a temporary difference of 185, but this 500,000, it needs to be limited. It needs to be limited to what? To 315, meaning that you've got taxable temporary difference of 3315 because this is taxable temporary difference. So you limit the recognition to this amount right here. You limit the recognition to this amount, meaning that the 500,000 is now limited to what? It's now limited to 315. And do you see the impact? The impact is such that you'll now have what? the impact is such that you'll now have a temporary difference of 0 instead of 185. And what will be the deferred tax asset or a liability? The deferred tax asset or a liability will also be 0. Then the movement, we are saying that you still started with 300, 69,300, and this is your 247, meaning that the movement in temporary difference, it'll be this minus the 247. So it will be just to wipe off the opening balance so that you can sit with 0. And the movement here will also be what? Will also be 69,300. So do you see? So now how will this look like? So profit before tax still 200,000, but the movement in temporary difference, we are saying that it will be 247, meaning that the current tax at 28% is what? 629,300. Then the current tax is 69,200, and the deferred tax movement will then be what? This multiplied by 29, which is 69,300. So as a result, you can then see what? You can then see that we have what? We have 560, and again, there is no tax recall. But the key takeaway here is the following. The key takeaway is the limitation when there is what? When there is insufficient insufficient future taxable income. What do? We limit the deductible temporary differences to the taxable temporary differences. So how does it work? What if we had, say, 2 or 3 more items? So what you will then do, you will add up the negatives and you will add up the positives and have them separately. Then you will compare whether the negatives exceed the positives. If they do, you will then need to look for guidance from the examiners. That examiners, do we believe that we will have sufficient taxable income? If they say yes, we believe that, then you recognize a deferred tax asset, meaning that you will allow the answer to be negative. If they say no, you don't allow the answer to be negative, you limit it to what? You limit it to the positive numbers. In our case, 315. And therefore, your deferred tax liability is 0. And movement will be the number you had at the beginning of the year minus your 0. So that is how that works. So that is how that works when we've got deductible temporary difference. So is this legal kind of questionnaire or consideration that we need to have at the back of our mind that we never worried about when we're dealing with taxable temporary differences? Okay, so now that is our discussion on what? That is our discussion on deductible temporary difference. So now let's look at unused tax losses.